Portfolio Construction and Risk Management. Chapter 11, Defensive Portfolio Strategies. Section 1, Hedging Basics. Hedging is about reducing damage when something you already own goes against you. The basic idea is simple. Add a position that may gain value when another part of the portfolio loses value. In that sense, a hedge works a lot like insurance. You pay a known cost up front in exchange for protection against an uncertain future loss. That also means the goal is not to create a jackpot in a crash, but to soften the blow and make the overall portfolio more resilient. A good hedge usually leaves you with smaller losses, not no losses. Different risks call for different hedging tools, and that is why there is no single best answer. Put options are often used when an investor wants clearly defined downside protection for a limited period of time. Inverse ETFs can offset market exposure too, but they tend to be more suitable for short-term tactical use rather than long holding periods. Futures are very flexible and can hedge broad market exposure efficiently, but they also require more experience, active monitoring, and comfort with margin. So the real choice depends on what you are trying to protect, how long you need protection, how much cost you can tolerate, and how much complexity you can manage. A put option gives its buyer the right to sell at a specified strike price before expiration or at expiration, depending on the contract. For portfolio defense, investors often use puts on a broad index rather than on every individual stock they hold. If the market falls, that put typically rises in value, which can offset part of the portfolio's loss. If the market keeps rising instead, the put may expire worthless, and the premium paid becomes the cost of protection. That is why puts are best understood as insurance, not as a free source of returns. Their usefulness depends on details like the strike price, the expiration date, and how closely the index matches the actual portfolio being hedged. Inverse ETFs and futures can both hedge market exposure, but each comes with practical complications. An inverse ETF is designed to move opposite a benchmark on a daily basis, and that word daily matters a lot. Over longer periods, compounding and path dependence can cause its return to drift away from the simple opposite of the index's cumulative move. Futures, by contrast, can be a very efficient way to reduce exposure, because a relatively small amount of margin can control a large notional position. But that efficiency comes with leverage, and leverage means moves can happen quickly in either direction. So both tools can be useful, but neither should be treated as a casual set-it-and-forget-it hedge. Every hedge has a cost, and some of those costs are obvious while others are easy to miss. With options, the premium is the clear upfront price of protection. With inverse ETFs, you may face fund expenses, tracking error, and trading friction. There is also an indirect cost when markets rise, because the hedge can reduce upside or make part of the portfolio less productive. If hedging is repeated again and again, those costs can compound over time and noticeably drag on returns. So effective hedging is never about asking whether protection is free. It is about deciding whether the protection is worth what you are paying for it. Even a well-designed hedge only reduces risk. It does not remove risk entirely. One reason is fit. The hedge may not behave exactly like the portfolio it is meant to protect. A second reason is structure, because a put option with a strike below the market may not help until losses have already begun. In stressed markets, liquidity can also weaken, spreads can widen, and execution can become less precise than investors expect. Sharp price gaps can make hedges behave less smoothly than textbook examples suggest. So the realistic goal is partial protection that improves outcomes, not perfect protection in every scenario. A practical hedge begins by naming the exact risk you want to reduce. That might be an equity market decline, a rise in interest rates, a currency move, or some other specific exposure. Once the risk is clear, the next step is choosing a tool that actually matches it instead of just buying something that sounds defensive. After that comes sizing. Do you want a full hedge, a partial hedge, or just enough protection to limit the worst outcomes? Then comes the part many investors underestimate, which is ongoing review. Hedges expire, markets move, exposures change, and good protection often needs to be adjusted, closed, or rolled forward rather than ignored. This example shows what partial protection looks like in practice. Imagine a $250,000 stock portfolio with a heavy technology tilt, and suppose the investor buys one S&P 500 put covering roughly $100,000 of exposure. The strike is set 5% below the current market, the expiration is 3 months away, and the premium costs $1,500. If the portfolio drops 7%, the stock loss is about $17,500. In that scenario, the port might rise to around $5,000, leaving a net hedge gain of about $3,500 after subtracting the premium. The portfolio still loses money, but the damage is reduced to roughly $14,000, which is exactly what partial hedging is meant to do. The trade-off becomes clear when the feared decline never happens. If that same portfolio rises 7% instead, the stock holdings gain about $17,500. But the put option likely expires worthless because there was no meaningful drop for it to protect against. The investor still paid the $1,500 premium, so the net gain falls to about $16,000. Nothing went wrong here. This is the intended cost of having insurance in place. A hedge can make bad outcomes less painful, but it usually makes good outcomes a bit less rewarding too. Many hedging mistakes come from implementation rather than from the instrument itself. One common problem is overhedging, where the protective position becomes so large that it starts acting like a speculative bet. Another is ignoring time decay, especially with options, because protection that looks cheap can steadily lose value as expiration approaches. Investors also sometimes choose the wrong hedge, which creates cost without much offset when the real risk appears. And even a sensible tool can disappoint if the notional size is wrong, or if nobody is monitoring it after the trade is placed. Good hedging requires fit, size, and follow-through all at once. The key idea from this section is that a hedge is a deliberate trade-off. You accept a known cost today in order to reduce the impact of an uncertain loss later. To make that trade-off worthwhile, the hedge has to match the actual risk in the portfolio, and it has to be sized carefully. It is also important to expect protection to be partial rather than perfect. Markets change, exposures change, and hedges need review as conditions evolve. When used thoughtfully, hedging is less about chasing return and more about building a portfolio that can hold up better under stress. Section 2. Defensive sectors. Defensive sectors are called defensive because the products and services they provide remain necessary even when the economy weakens. People may cut back on vacations, new cars, or luxury spending, but they still buy groceries, use electricity, and need medical care. Because demand for these essentials tends to hold up better, company revenues in those sectors are often less cyclical. That does not mean earnings never fall, but they usually move less dramatically than in more economically sensitive industries. In recessions, that relative stability can help these sectors decline less than the broader market. So what makes a sector defensive is not magic. It is the steadiness of the demand behind the business. The classic defensive sectors are consumer staples, healthcare, utilities, and telecommunications. Consumer staples include everyday goods such as food, beverages, household products, and personal care items that people keep buying almost regardless of the economic cycle. Healthcare is defensive because medical needs do not disappear in a recession, even though the sector still has its own policy and pricing risks. Utilities provide essential services like electricity, gas, and water, which creates a relatively stable demand base. Telecommunications can also fit this group because mobile service and internet access have become close to essential for households and businesses. Together, these sectors tend to form the core of a defensive equity tilt. The difference between defensive and cyclical sectors comes down to how easily spending can be postponed. Defensive sectors sell essentials, so demand usually stays fairly steady whether the economy is strong or weak. Cyclical sectors depend more on discretionary spending and business confidence, which means demand tends to rise in good times and fall sharply in bad times. Travel, autos, restaurants, and many industrial businesses are typical cyclical examples, because households and companies can delay those purchases. By contrast, staples and utilities are harder to delay because they are built into daily life. That is why sector behavior across the cycle can look so different, even though all of them are part of the stock market. Defensive sectors often hold up better because stable demand can lead to steadier business performance. If sales are more consistent, Cash flows are usually more predictable, and investors often place a higher value on that predictability during downturns. These businesses may also be less tied to swings in consumer confidence or corporate spending plans. Some have durable market positions, established brands, or regulated business models that make results less volatile. Many also pay dividends, which can provide part of total return even when share prices are under pressure. None of this makes them immune, but it helps explain why they often fall less when the economy slows. It is important to be precise here. Defensive does not mean safe from loss. In a bear market, defensive sectors can still decline sharply along with everything else. The difference is usually relative, not absolute. If the broad market falls 30% and a defensive group falls 18%, both outcomes are painful, but the smaller drawdown leaves the investor in a stronger position. That matters because recovering from a smaller loss requires a smaller rebound. So the real benefit of defensive sectors is resilience, not immunity. The 2008 financial crisis gives a clear example of relative resilience. The S&P 500 fell by roughly 38%, which was a severe broad market drawdown. Consumer staples also lost value, so this was not a case of protection from all losses. But staples fell by about 20%, which was meaningfully less severe than the overall market decline. That gap matters because it reduces the depth of the drawdown and can make recovery easier. The lesson is not that staples always outperform in every crisis, but that essential demand sectors often cushion equity damage when fear spreads through the market. Building a defensive tilt means adjusting equity exposure, not abandoning equities altogether. An investor might reduce weight in more economically sensitive areas and shift part of that capital towards staples, healthcare, utilities, and telecom. This can be done through sector ETFs for broad exposure or through carefully selected individual companies. In either case, quality matters, because financially durable businesses with stable earnings and manageable debt tend to fit the defensive goal better than weak companies in a defensive label. The shift should also be reviewed over time rather than treated as permanent no matter what. In practice, a defensive tilt works best as a measured repositioning, not an all-or-nothing bet. Here, the portfolio is being reshaped, not completely reinvented. It begins with 70% in the S&P 500 and 30% in technology, which creates a fairly growth-oriented equity mix. Then 40% of the portfolio is shifted into defensive sectors, leaving 50% in the S&P 500 and only 10% in technology. The new defensive sleeve is spread across 15% consumer staples, 15% healthcare, and 10% utilities. This kind of move keeps the investor broadly invested in equities while reducing concentration in a more volatile area. It will not remove market risk, but it can make the portfolio less sensitive to an economic downturn or a growth-led sell-off. A defensive sector strategy has real limits, and investors should be careful not to overstate its power. Defensive sectors can still be expensive, and if valuations become stretched, the margin of safety may disappear. They also carry sector-specific risks, such as regulation in healthcare, interest rate sensitivity in utilities, or crowded positioning in staples. In addition, these sectors may lag badly when the market shifts back into a strong recovery and cyclical businesses rebound faster. So, sector defense can reduce volatility, but it is not a complete risk management system by itself. It still needs diversification, valuation discipline, and coordination with the rest of the portfolio. A few mistakes show up repeatedly when investors try to use defensive sectors. One is assuming that all defensive sectors behave the same way, when in reality utilities, healthcare, and staples can respond very differently to rates, policy, and valuations. Another is over-concentrating in a single sector, which replaces broad market risk with a narrower industry risk. Investors also get into trouble when they ignore valuation and buy defensive stocks only after they have already become expensive crowd favorites. And perhaps the biggest mistake is treating sector rotation as the whole defense plan instead of one tool within a broader portfolio strategy. Defensive sectors can help, but they work best alongside diversification, cash management, and thoughtful rebalancing. Section 3. Bonds and safe havens. Bonds and other safe haven assets matter because their main role is to stabilize the portfolio when riskier holdings come under pressure. In periods of stress, investors usually care less about maximizing return and more about preserving capital, maintaining liquidity, and avoiding forced decisions. High-quality defensive assets can cushion equity drawdowns by declining less, staying stable, or sometimes even rising. They also provide liquidity, which is especially valuable when markets are strained and opportunities may later appear. That is why they are often described as portfolio ballast rather than return engines. Their job is not excitement, their job is resilience. High-quality bonds often act as portfolio ballast because investors tend to move towards safety during recessions or deflationary shocks. When fear rises and growth expectations fall, government bond yields may decline, which can lift bond prices. That creates a helpful counterweight to falling stocks. Their defensive value also comes from liquidity. Since major government bond markets are deep and can usually be accessed when investors need to rebalance or raise cash. But this relationship is not guaranteed in every environment. Inflation shocks, aggressive tightening, or unusual policy conditions can weaken or even reverse the usual stock-bond cushion. Not all bonds deserve the same defensive label. Two of the biggest differences are credit quality and duration. Credit quality tells you how strong the issuer is and how much default or spread risk the bond carries, while duration tells you how sensitive the price is to changes in interest rates. In a crisis, those distinctions become very important. A short-term treasury and the long-duration high-yield bond may both be called bonds, but they can behave nothing alike under stress. Treating all bonds as equally safe is one of the most common mistakes in defensive portfolio construction. In downturns, the strongest bond defense usually comes from the highest quality issuers, especially government bonds. Treasuries tend to offer the best combination of credit safety and liquidity, which is why they often hold up well when recession fears rise. Investment-grade corporate bonds may provide more income, but they are still exposed to widening credit spreads, so their protection is less reliable in stress. High-yield bonds are even less dependable as a defensive asset because they often trade more like equities than like safe havens. When economic conditions deteriorate, investors quickly become more sensitive to default risk. So, for crisis defense, issuer quality matters at least as much as the word bond on the label. Duration helps explain why even safe bonds can lose value when interest rates rise. The longer the duration, the more a bond's price tends to move when yields change. That means a long-term treasury may provide strong protection in a deflationary recession, but it can also suffer large losses when inflation is rising and central banks are tightening policy. Short to intermediate term bonds often fit a defensive role better because they usually carry less rate sensitivity. They may not surge as much in a favorable bond rally, but they also tend to be less vulnerable when yields move up. So bond defense is not only about safety of issuer, it is also about choosing the right maturity exposure. Safe havens beyond bonds exist because different crises produce different kinds of damage. T-bills and cash equivalents are useful when maximum liquidity is the priority. Cash itself holds nominal value well, though it offers little return and can quietly lose purchasing power during inflation. Tips are often more useful when the concern is inflation rather than recession. Gold can diversify certain kinds of stress, especially monetary or geopolitical shocks, though it brings volatility and no income. Some investors also use defensive currencies, but that adds a new layer of currency risk, which means even a safe haven can create a different exposure. Every safe haven asset comes with a trade-off, so the right choice depends on the risk you most want to defend against. Government bonds are often strong recession hedges, but they can be hurt by inflation and rising rates. Investment-grade corporates offer more income, though that extra yield comes with credit risk. Cash and T-bills provide excellent stability and liquidity, but their return is limited. Tips are better for protecting against inflation, yet they may be less helpful in certain liquidity-driven shocks. Gold can help in some inflationary or geopolitical environments, but it produces no yield and can be more volatile than many investors expect. A practical defensive allocation starts by identifying the threat you are trying to address. If the main fear is recession, high-quality government bonds may deserve the central role. If inflation is the bigger concern, then cash, tips, or a small gold allocation may play a larger part. Investment-grade corporates can be added carefully when modest income is needed, but they should not be mistaken for pure crisis protection. The key is to build the allocation deliberately instead of collecting random, defensive-sounding assets. And because market conditions change, the allocation should be monitored and rebalanced, rather than left on autopilot. This example shows how a defensive mix can soften a recession scare. In a $500,000 portfolio, $200,000 is in short-term treasuries, $100,000 in investment-grade corporates, $50,000 in gold, $50,000 in a money market fund, and $100,000 in equities. Under stress, suppose treasuries rise 3%, corporates fall 1%, gold and cash are flat, and equities fall 15%. That produces a $6,000 gain from treasuries, a $1,000 loss from corporates, and a $15,000 loss from equities. The net portfolio change is a loss of about $10,000, or roughly 2% overall. The portfolio still declines, but it holds up far better than an all-equity position would in the same scenario. A defensive mix only works well when it matches the kind of shock that actually arrives. In a deflationary recession, treasuries may perform very well because falling yields support bond prices. But in a high inflation shock, those same nominal bonds can struggle, even if they looked defensive in the previous crisis. A credit downturn can also hurt corporate bonds more than many investors expect, because spread widening can overwhelm their income advantage. That is why some investors combine nominal bonds with TIPS, gold, or cash to broaden the defense. The deeper lesson is that there is no universal safe haven. Defense has to be matched to the stress you fear most. Several mistakes repeatedly weaken defensive bond allocations. One is chasing yield by extending too far into long-duration bonds without respecting how much rate risk they carry. Another is assuming all corporate bonds are safe simply because they are bonds, when lower quality credit can behave much more like equity in a downturn. Investors also underestimate inflation, focusing on account stability while ignoring purchasing power. Some go too far the other way and overuse gold, which creates concentration in a volatile, non-income producing asset. And after stress passes, many fail to rebalance, which leaves the portfolio drifting away from its intended defensive structure. Section 4. Inflation Protection. Inflation matters because a portfolio can appear stable in dollars while still becoming less valuable in real life. If prices for goods and services keep rising, the same account balance buys less over time. That means cash can quietly lose purchasing power during inflation surges even when its nominal value does not change. Fixed-rate bonds face a similar problem because their coupons are paid in dollars that may be worth less in real terms. For a defensive investor, preserving purchasing power is just as important as reducing volatility. Real stability matters more than simply seeing a steady account statement. Inflation risk has two parts: what markets already expect and what catches markets by surprise. Expected inflation is usually built into current prices and bond yields, so it is not always the main source of damage. The bigger problem is unexpected inflation, when actual inflation comes in above what investors had priced in. That surprise can come from supply shocks, policy errors, or sudden changes in the economic environment. Nominal bonds tend to suffer the most in that kind of jump because their fixed payments are suddenly less attractive in real terms. So defensive portfolios are especially concerned with inflation that exceeds expectations, not just inflation in general. Nominal bonds are vulnerable because they promise fixed dollar payments, not fixed purchasing power. If inflation rises faster than expected, the coupon and principal do not adjust upward to compensate. As a result, the real return on the bond can shrink and may even become negative. Longer duration nominal bonds are often hit harder because more of their value depends on cash flows far in the future, which inflation erodes more heavily. Cash has a related weakness. It may feel stable, but it also buys less when prices rise. So nominal safety and real safety are not the same thing. TIPS are designed specifically to address that real purchasing power problem. Their principal adjusts with the consumer price index, so when inflation rises, the value on which interest is calculated rises as well. That gives TIPS a more direct link to inflation than ordinary nominal treasuries. For many investors, they are the first tool to consider when adding inflation protection to the bond sleeve of the portfolio. They are still government bonds, so they can fit naturally into a defensive allocation. In simple terms, TIPS are meant to preserve real value more directly than fixed coupon bonds can. Even so, TIPS are not a perfect shield against every kind of bond risk. They protect against inflation, but they are still sensitive to changes in real yields. If real yields rise, TIPS prices can fall, sometimes sharply, even during a period when inflation is elevated. That surprises investors who assume inflation protection means price stability. Low inflation can also lead to low nominal yields, which may make TIPS feel underwhelming in calm periods. Shorter duration TIPS can reduce some of this sensitivity, so maturity choice still matters even within an inflation-protected allocation. Real assets can complement TIPS because inflation does not always spread through the economy in the same way. Commodities may respond quickly when input, energy, or transport costs rise. Real estate can help when rents adjust upward over time, though that adjustment may not be immediate. Infrastructure assets may also offer some linkage if contracts or pricing structures move with inflation. But none of these are clean, guaranteed hedges, and all can be volatile. That is why they are usually better used as complements to TIPS rather than as replacements for them. Gold and equities are often described as inflation hedges, but their roles are narrower than many investors assume. Gold tends to respond more to monetary stress, confidence shocks, or real rate changes than to routine moderate inflation by itself. That means its short-term relationship with inflation can be inconsistent. Equities can preserve purchasing power over very long horizons, but they are not a dependable short-term inflation hedge. Rising input costs can squeeze margins, and higher interest rates can pressure valuations at the same time. So both assets may help in certain inflation environments, but neither should be treated as a simple all-purpose inflation defense. A practical inflation protection mix is usually built around balance rather than prediction. TIPS often serve as the primary hedge because they are the most direct bond-based tool for protecting purchasing power. A modest sleeve of real assets may be added when an investor wants broader protection across different inflation scenarios. Floating rate or shorter duration tools can also help reduce sensitivity to rising rates. The key is not to place a huge bet on one macro outcome. Defensive inflation protection works best when it is large enough to matter, but small enough to remain disciplined. Sizing matters because inflation protection should support the portfolio, not take it over. A sensible starting point is to first measure how much of the portfolio sits in cash and nominal bonds, since those are the areas most exposed to inflation surprises. From there, some investors begin by placing about 10 to 20% of the bond sleeve into TIPS. Real assets are often kept smaller, perhaps around 2 to 5% of the total portfolio, because they can be more volatile and less predictable. The allocation can then be adjusted for risk tolerance and inflation concern. Rebalancing is usually better than chasing whichever inflation hedge has recently performed the best. Inflation protection works better when valuation, taxes, and account placement are considered together. One important concept is break-even inflation, which is the market's implied inflation expectation derived from nominal treasury yields and TIPS yields. If break-evens are already very high, TIPS may still be useful, but they may no longer be especially cheap. Taxes matter too, because TIPS can create taxable phantom income when principal adjusts upward even if that increase is not paid out in cash immediately. For that reason, tax-advantaged accounts are often a more efficient place to hold them. Good inflation defense is not just about choosing the right asset, but also about owning it at a sensible price and in the right account. This example shows inflation protection as an active but disciplined adjustment, not a permanent all-in bet. In 2021, an investor with a bond sleeve heavy in nominal treasuries judged inflation risk to be underpriced and sold part of that nominal exposure. The proceeds were moved mainly into a broad TIPS fund, with a small commodity position added for extra sensitivity to inflation shocks. When inflation later surged, those positions helped cushion the bond sleeve relative to staying fully in nominal treasuries. But the process did not end there. As the inflation trade became more crowded and those positions appreciated, investor trimmed winners and redeployed through rebalancing, which is how protection stays strategic instead of becoming speculation. Section 5. Crisis positioning. Crisis positioning is different from ordinary defensiveness because it is built for severe, system-wide stress rather than a routine slowdown. In a true crisis, normal diversification can weaken as many risky assets start falling together. That is why crisis positioning focuses first on liquidity, capital preservation, and flexibility. The idea is to hold enough resilient assets that you are not forced into bad decisions when markets become disorderly. Just as important, it keeps dry powder available for later redeployment when prices are lower and conditions begin to stabilize. So crisis positioning is not simply being cautious. It is preparing for the possibility that correlations and market behavior may change abruptly. Ordinary defenses may fail in major crises because the assumptions behind them can break down. Risky assets that usually diversify one another can suddenly decline together when fear and forced selling spread across markets. Liquidity can become more important than valuation, especially if leverage is unwinding and investors need cash quickly. Even long-duration bonds, which often help in recessions, can struggle in inflation shock. And diversifiers such as gold, credit, or foreign assets may behave differently depending on whether the crisis is about deflation, liquidity, inflation, or policy credibility. In other words, the success of a defense depends not just on the asset, but on the type of shock. A crisis-ready portfolio accepts a clear trade-off. It is not designed to win during calm bull markets because holding extra liquidity in safer assets usually creates some return drag. The reason investors accept that drag is the potential for smaller drawdowns when conditions turn sharply negative. A smaller drawdown can preserve both capital and decision-making freedom. It also means the investor may have cash available to buy attractive assets later, instead of being forced to sell into weakness. So the sacrifice is some upside in good times in exchange for resilience and optionality in bad times. The core assets in a crisis layer are usually chosen for liquidity first and return second. Cash and cash equivalents provide immediate flexibility and are often the most important holding when markets are disorderly. Ultra-short treasuries can add a bit of yield while keeping rate sensitivity relatively low. Long USU treasuries may still deserve a place because they often help in deflationary shocks, though they are less dependable in inflationary crises. Some investors also use gold or US dollar exposure as secondary defenses against confidence stress, monetary disruption, or geopolitical shocks. The common thread is that no single asset works in every crisis, so the layers should be built with that limitation in mind. Preparation happens before the headlines become alarming. Instead of trying to predict the exact timing of trouble, the investor maintains a standing crisis layer as a structural reserve. That reserve might be around 10 to 20% of the portfolio and is usually held in highly liquid defensive assets. The key idea is permanence. It is there in calm periods, in stressful periods, and in full crises. That discipline helps prevent emotional, last-minute scrambling when markets start falling quickly. The cost is that the reserve may create an annual drag of roughly 1 to 3% in strong markets, but that drag is the price of having resilience ready in advance. Activation begins when predefined signs of systemic stress appear, not simply when news becomes scary. The investor uses rules established in advance, such as a volatility threshold, a sharp index decline, or another objective measure of disorder. When those triggers are hit, the crisis layer may be increased toward 30 to 50% of the portfolio. At the same time, exposure to high beta equities, lower quality credit, and leveraged positions is reduced. This rules-based approach matters because crisis conditions tend to amplify emotion and second-guessing. A prepared framework makes it easier to respond consistently when pressure is highest. Rotation is the re-entry phase, and it is where discipline matters just as much as during the sell-off. The goal is not to call the exact bottom, which is usually impossible in real time. Instead, capital is redeployed gradually as panic eases and market structure begins to normalize. That might mean re-entering in planned increments over several weeks or months rather than in one large move. Volatility, liquidity, and price behavior can help guide the pace. Keeping some reserve in place is also wise, because crises often produce retests or false recoveries before a more durable rebound begins. March 2020 is a good example of how a rules-based plan can help when markets move very fast. Imagine a $500,000 portfolio with a trigger that activates if the portfolio falls 12% in 5 days. On March 10, $150,000 of equities is sold and moved into Treasury money funds and short-term TIPS, while a 10% gold allocation is retained. When the market later reaches its deeper drawdown, the portfolio declines much less severely than the broad index because part of the risk had already been cut. Then, As policy support arrives and panic begins to ease, some of the crisis cash is redeployed gradually rather than all at once. The value of the plan is not perfect timing. It is reducing emotional decision making while preserving the ability to participate in recovery. Several mistakes can undermine even a well-intended crisis plan. One is staying defensive too long after the major decline has passed, which can leave the portfolio underexposed during the recovery. Another is assuming bonds always protect, even in crisis types where inflation or rate shocks hurt them too. Some investors rely too heavily on options alone, forgetting the cost, timing pressure, and expiration risk that come with them. A particularly damaging mistake is changing the rules in the middle of the crisis because that often turns a disciplined process into emotional improvisation. Good crisis positioning works best when defenses are diversified, rules are simple, and the investor remains committed to the plan under stress. A simple crisis playbook should be clear enough to follow when emotions are elevated and markets are moving quickly. It begins with choosing a baseline crisis layer so part of the defense already exists before trouble starts. Then it sets one or two objective activation triggers that determine when defenses are increased. The playbook should also prioritize liquidity over squeezing out a little extra return, because access to capital matters most in real stress. Finally, it should include a staged re-entry rule, such as a 6-month schedule for gradually rotating back into risk as conditions stabilize. The point of the playbook is not prediction. It is preparation that can actually be followed when the pressure is real.